Diane Sandoval, CalPERS team member with the Trust Level Portfolio Management and Implementation team. Allison and I are very excited to talk to you this afternoon about our capital market assumptions, because trying to predict the future is one of the most interesting things you do as an investor. And I know we are the last presentation at the end of a really informative day. And Tom and Steve from Wilshire did a great job earlier in the day to touch on many of the topics we will cover. So certainly feel free to interrupt me or Allison as we move through this. We'd like this to be a robust discussion, and I find it is generally more interesting when we have higher engagement from the audience. With that, if I can ask everyone to please turn to page 2 of the presentation. Thank you. I will begin this afternoon's discussion by providing you with an overview of capital market assumptions. I will define them, explain how they are used, and why they are important. Next, I'll provide a review of how CalPERS has established capital market assumptions in the setting of our strategic asset allocations for the Public Employees Retirement Fund and the affiliate funds. I'll then turn it over to Allison Lee to walk you through examples of our process and the many important assumptions used in these models. Finally, Allison will review our plans for future developments to enhance and address the limitations of our current models. With that, if you could please turn to page 3. Thank you. I will begin by defining capital market assumptions as beliefs about the future performance of asset segments that incorporate theories, observations, and our experience. In order to create these capital market assumptions, investors make many simplifying assumptions about investment behavior that, in reality, are much more complex. Because the real world is much more complex and is constantly changing, it's important to always remember that forecasting capital market assumptions, as I think Ben has said many times, is truly a mix of art and science. As described by Wilshire earlier, there's 3 components to capital market assumptions shown here as expected returns, volatility, and correlation. Throughout this presentation, we are using color coding scheme in the text. The green color denotes the desired component of an investment, such as the expected return, as rational investors will always seek to obtain the highest possible return. In contrast, the red color denotes the undesired component of an investment, such as the riskiness or volatility around its expected return. The interaction between the assets, which is characterized by correlations between their respective returns, is also shown in red as undesired. This is because, as Wilshire mentioned earlier, one of the key objectives of strategic asset allocation is to achieve diversification. Basically, to reduce the overall risk in the portfolio by investing in assets that behave differently during different economic regimes. This allows us to lose less during economic downturns, smooth out the compound returns that we are able to earn, and preserve wealth over the long run. As Albert Einstein once famously stated, compound interest is the 8th wonder of the world. He understood that it's not just about how much money we make, but how much we keep, how hard it works for us, and how many generations we keep it for. Thus, the higher the correlation and the more alike our asset segments behave, the less diversification benefit we can achieve. And just like volatility, higher correlation is undesired and is and should be shown in red. Turning to page 4, I show that a 10-year horizon is common for asset liability management purposes. As described earlier by Wilshire, this allows the strategic asset allocation to serve as an appropriate roadmap over a market cycle. This time frame matches the experience we have had in the United States since the 80s, where we've had a major economic recession, as defined by the National Bureau of Economic Research, approximately every 10 years. More importantly, this long-term horizon enables us to earn an illiquidity premium in the private asset classes, invest in opportunities that take longer to realize, and hold on to or add positions during market dislocations. Of course, as the agency that manages pension and health benefits for California's public employees, we have to deliver sustainable investments to our 2 million members for decades to come. Thus, some pension funds have chosen to use a 20-year horizon as inputs into their strategic asset allocation process, but this is less common. Let me pause for a moment because I've just run through those pages very quickly before we turn to page 5 if there's any questions.
No, there are no questions, so continue.
Okay. Turning to page 5, I show you how we use capital market assumptions as critical inputs into the portfolio construction process. Again, as described by Wilshire earlier, we construct portfolios based on mean variance optimization, or MVO for short. MVO assumes that investors are rational and that they consider expected return, as desired, and the risk of the investment achieving its expected return as undesired. The optimal portfolio for any investor under mean variance optimization is based on a really simple idea. Basically, it creates a trade-off between the desired and the undesired. To gain more of the desired or the expected return, we will be required to take on more of the undesired or expected risk. It's not much different than decisions we make every day where we're trying to determine which solution will provide us the biggest bang for our buck. MVO reduces a very complicated real-world problem into a rather simple mathematical process. This process makes simplifying assumptions that differ from reality. So before we run the MVO, we must incorporate investment constraints to address these limitations to the model. For example, mean variance optimization process assumes that any class or asset segment is scalable from no inclusion to literally being the entire portfolio. For deep and liquid asset classes, such as global equities or fixed income, these are very reasonable assumptions. However, for less liquid asset classes, such as private assets or even high yield, where a large allocation could have a negative market impact on the pricing, a maximum constraint serves as a practical check on the market feasibility of the allocation. Another important reason to utilize constraints is that MVO assumes that all risks associated with a portfolio can be captured by the volatility of returns. The reality is, as Wilshire walked through earlier, CalPERS risks are multifaceted and should consider an expanded array of attributes, liquidity, drawdown, and income, just to name a few, that will allow us to preserve wealth and enhance the sustainability of the fund over the long term. Placing a minimum constraint on bonds is one way to ensure that the portfolio has enough liquidity and protection against drawdown risk. Once we define CMAs and the investment constraints, we can use the MVO to find the set of portfolios with the highest return for any given level of risk. Now, this vastly simplifies the portfolio selection problem because investors need to only consider the portfolios on the efficient frontier rather than the entire universe of possible portfolios. MVO also quantifies the notion that diversification reduces risk. I'll show you exactly how this is done in a couple of slides. If you could turn to page 6. Thank you. I'm going to show you how we put this theory to a test with a simple 2-asset bond and stock example. Recall that we first start with theory, observations, and experience to derive capital market assumptions for each asset segment, and that there's 3 pieces of information we need to do this: expected return, volatility, and correlation. Now let's say the CMAs for stocks and bonds are accurately shown in this table, with stocks earning more than double the return and risk than bonds, and bonds being slightly negatively correlated to equities. The next question we must address is what is the right mix of stocks and bonds for a portfolio? This is where we use MVO to guide us to an answer. On page 7, I show a graphical presentation of all possible asset mixes of this stock bond portfolio. The x-axis represents the expected portfolio risk, again, that's the undesired, and the y-axis represents the expected portfolio return, the desired. We will start with the scenario of 82% bonds and 18% stocks, and end with the scenario of 100% stocks and no bonds. We also plot the portfolio expected return and risk for all possible portfolios in between these 2 portfolios. I also listed in there in the middle the 60-40 portfolio, since many investors view this as a passive portfolio. The portfolio is considered to be efficient, or a portfolio is considered to be efficient, if no other portfolio offers a higher expected return with the same level of risk, or if no other portfolio offers lower risk with the same or higher return. The efficient frontier represents the set of all portfolios with the highest return for each level of risk, or the lowest risk for each level of return. That's shown here as the blue line. As shown in the previous slide, stocks are riskier than bonds, exemplified by its higher volatility than bonds. As we allocate more to stocks, risk goes up. At the same time, portfolio expected return goes up since we are assuming more risk. In addition, and in accordance with our investment belief, we should be compensated for more risk in the form of higher expected return. Thus, we should expect an upward sloping curve for the efficient frontier, and that's exactly what we see on this page. On page 8, I demonstrate that the efficient frontier can change as factors such as correlation between the assets change. Recall that in MVO, expected return is desired and expected volatility is undesired. Thus, ideally, we would like the efficient frontier to go up along the y-axis and go to the left along the x-axis. That is, we would like the efficient frontier to go towards the upper left direction. In the previous bond and stock example, I assumed a correlation of negative 0.1 between stocks and bonds. This blue line continues to represent the efficient frontier from that example. As correlation goes up from negative 0.1 to 1, the efficient frontier goes to the less desirable direction or toward the lower right corner because we are getting less of the diversification benefits. So every portfolio option is less efficient and requires more risk and lower return. Alternatively, as correlation goes down, the efficient frontier goes to the more desirable direction, the upper left corner, because we are getting more of the diversification benefits. This confirms our belief that in MVO, higher correlation, just like risk, is undesired. It also illustrates the point I made earlier, that MVO quantifies the notion that diversification reduces risk because at every point on the efficient frontier, you can quantify how much additional risk you will have to take in order to earn additional return. I'll pause here to see if there's any questions before I move on.
Yes, we do. Ms. Taylor?
Okay, hearing none.
Yeah, no, we have one, Ms. Taylor.
So Diane?
Hello.
Hi, thanks for doing this. This is very good. I don't think I've had this explained before. So the MVO, I thought earlier, Wilshire's, their presentation, they talked about constraints, and constraints that they explained meant that our returns were probably going to be worse because of constraints implied. It's you're explaining it differently, showing us that it actually could help returns. Could you kind of explain that for us?
Yeah, so let me be clear. So I'm not saying anything different from what Wilshire said. What I'm showing you is an example about how correlation impacts the efficient frontier. Adding constraints into this process should, exactly as Wilshire described, without the use of leverage, push the efficient frontier down to the less desirable location. And the reason for that is because constraints essentially don't allow you to get as much, let's say, of those high returning assets, because you usually put a maximum constraint on the higher returning assets, and you put a minimum constraint on the lower returning assets. So it forces you to a less efficient place. But the reason we have to use constraints is because otherwise you would get very impractical outcomes. So, you would get portfolios which would want to have a huge amount allocated to private assets and private equity in particular. And you might get portfolios with, zero or no bonds. So that would be, that's what I was saying earlier, is that you really need to adjust for a holistic view of what you define as risk, because risk in this framework is just one dimensional. It's the volatility of returns. And risk to CalPERS is multidimensional. And therefore, we really do need to consider um, liquidity, drawdown, income, many other dimensions that are not considered into this framework. Besides that, it's just from a feasibility, even if we wanted to increase the allocation to private equity from, let's say, 8% to 16%, that would be very, very difficult to do without impacting pricing in that market. High yield is another example where, if we wanted to move our allocation from 3% to 20%, you're given the size of, 400 billion assets, you are very likely to move the market. And so it just wouldn't allow you to have that pricing discipline.
Okay, great. Thank you. That helps explain it. Thanks.
You're welcome. You're welcome.
Okay, continue.
All right. So moving to page 9. The previous example shows how MVO provides asset allocators a common analytical framework whereby there's only one decision factor, the investor's risk tolerance, or how much risk an investor is willing to take, that needs to be determined in order to select the portfolio weights. As Wilshire said earlier, this is an incredibly powerful framework developed in 1952 by Harry Markowitz, who then won the Nobel Prize. And it really shows us how MVO reduces a complex real world problem into a rather simple framework within which an investor's preference is clearly defined and fully quantifiable. Now, as is true for the application of any theory to real life, it is important to know the underlying assumptions of the theory and to assess how realistic these assumptions are. Our goal in identifying and understanding these shortcomings is to try to make appropriate adjustments or add additional lenses that allow us to have a more holistic approach to solving the problem and hopefully to build a much stronger portfolio. Earlier, describing the need for using constraints, I walked through the practical limitations of MVO. And again, really the biggest limitation there is that volatility captures all the risks that CalPERS would care about, when in fact, we have an investment belief, number 9, that clearly states the contrary, that our risks are multifaceted and include a broad range of investment and actuarial risk measures. 2 other important assumptions worth mentioning are that asset returns are normally distributed and that mean returns, volatility, and correlations are constant and known. Now, both of these assumptions are made because it is mathematically and statistically convenient. The reality is that asset returns tend to have higher peaks and longer tails than a normal distribution would predict. Also, asset returns are time varying and tend to behave very differently under different economic regimes and conditions, as we've seen, in this last crisis through COVID. So in order to counterbalance these simplifying assumptions, we establish constraints, but we also rigorously stress test portfolios using Monte Carlo simulations. And I think Scott talked about those simulations where we literally have, over 10,000 simulations. And we also stress test our potential candidate portfolios through economic scenarios to understand the ability of these portfolios to meet a set of investment and actuarial metrics given the risk tolerances defined by the board. If I can ask you now to turn to page 10. Thank you. I will walk you through a broad overview of our process for setting CMAs. Because we know that forecasting CMAs involves quite a bit of art as well as a science and is dependent on us getting a lot of assumptions about the future right, we build quite a bit of humility into our process. So here I show you the 3 steps that we follow. First, we build our own internal CMA models based on experience and coupled with cutting-edge practices and techniques from leading practitioners in the industry. Second, we add humility to the process by including CMA survey results of several asset managers and consultants and really digging through to understand the drivers of significant differences being made in their assumptions versus our assumptions. Third, we build consensus on asset segment CMAs with team members from trust level portfolio management and implementation, the research and strategy group, asset class experts, actuaries, our CIO, our COCIO, and our board consultants to establish what we think the marketplace has to offer. With that, I will turn this presentation over to Allison Lee from our Research and Strategy Group to walk through specific examples of how we forecast our capital market expectations. Over to you, Allison.
Thank you. Good afternoon, members of the board, and thank you, Diane, for that very illuminating introduction to the definition of CMA and the very important role they play in our strategic asset allocation and the asset liability management process. I'll pick up from the beginning of our CMA methodology, which is our internal CMA models. Please turn to the next slide, please. As a researcher, this is the part that we are very excited about. Investing is about forecasting, and CMAs should incorporate everything we know about an asset class, yet represented in a succinct way to focus on the essential elements. So here, let's see the expected return for the two major public asset class, equity and fixed income. Wilshire's presentation earlier this afternoon has touched upon their analysis of expected returns of equities. The building blocks here are a deeper dive into their IGB model on page 66, which is slide 17 of their presentation. Yield, the same as income, is the I. Growth in yields is the G, and the valuation change is the V. This expression goes back to the basics of the valuation of any financial asset. Warren Buffett, in Berkshire Hathaway's 1992 annual report, wrote, and I paraphrase, "In the theory of investment value, written in 1938, John Burr Williams set forth the equation for value, which we condense here. The value of any stock, bond, or business is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. Therefore, I is the cash inflow today. However, we do not expect cash flow to remain constant within our forecast horizon. Thus, G is how much the cash flow will grow within our forecast horizon. Growth comprises two elements, inflation and real GDP growth, two factors impacting equity returns. The V block is the tricky part and an improvement upon the basic valuation theory to represent what happens beyond our forecast horizon for the remaining life of the asset. Turning to fixed income, we just discussed that the basic valuation theory applies to any financial asset. Yet each asset class has its uniqueness in terms of contractual cash flows. Comparing to equities, fixed income is less exposed to the growth factor because its cash flow is fixed. Thus, growth is not a separate block. However, growth factor does affect future yield curve and future credit spread. Future yield curve is input to the yield block because here yield refers to average yield between now and the end of the forecast horizon. And future yield curve and future credit spread are inputs to the valuation change block. Specific to fixed income, roll return with respect to a fixed rate fixed income portfolio captures the fact that the value of the portfolio will change because of the passage of time. For example, on an upward sloping yield curve, with the passing of 1 year, a 10-year duration portfolio becomes a 9-year duration portfolio. So it slides down the yield curve, and lower yield brought about extra return. In addition, fixed income also suffers from credit loss. Investment grade mainly suffers from the loss from ratings downgrade, while high yield mainly suffers from defaults net recovery. In summary, this slide introduces our methodology for the two major public asset class and explain how our methodology is consistent with the valuation equation and incorporate the specific contractual cash flow of each asset class. So since this is the basic fundamental valuation equation, I'll just pause here to see if there's any questions.
Yes, I have a question on the fixed income line. What's the roll return, the second half of the year? What's that?
Yes, the roll return is specific to fixed income. It just captures the uniqueness of fixed income that the value of the portfolio actually change because of the passing of time, even though if you assume the yield curve remained the same.
Okay.
So the yield curve is like generally it's upward sloping. So your 10-year duration portfolio is here. After 1 year, it's 9-year duration portfolio. So it slides down. And because of the lower yield, it brings you higher return because the price and yield are in the opposite direction for fixed income.
Okay, so it's really rolling down.
Yes. Rolling
Okay,
down.
all right. Okay, thank you.
Any other questions?
No further questions.
So it's reasonable to expect that every estimate should adhere to the same fundamental valuation equation. Then why is there such dispersion in the estimates? So let's move on to the next slide. So here, let's see the example of equities again. Current yield is public information, thus everyone agrees more or less on block I. However, there are myriad inputs and methodologies in determining the G block. Some shops look into past growth rate, whether they are the average in the past 10 years or during a full business cycle. Some will adjust the numbers deemed outliers, while others won't. Other shops rely heavily on analyst consensus forecast, whether they are calculated based on consecutive earnings forecast or the growth rate was forecast explicitly as a growth rate. Still, there are others form their growth forecast based on the analysis of future trends in technology and population. Thus, it's quite natural that there is a large dispersion in the G block, and the same applies to the V block. So that's a brief introduction to the basic valuation equation for public assets, equity, and fixed income. If there are no further questions, we'll move to the next slide for private asset class.
Continue.
So there are several segments within private asset class, such as buyout, venture, mezzanine debt, and distressed debt, etc. We usually leverage our knowledge and data from public markets to the corresponding private markets. This is consistent with our understanding that private markets are levered and illiquid public markets. Here are the building blocks of expected returns for buyout and venture, which constitutes 90% of the private equity market. Buyout and venture private equity expected returns start with public equity expected returns. Firstly, we adjust for beta because private equity companies usually have more sensitivity to systematic equity risk because of their size, development stage, industry, or geographical location. Secondly, we adjust for financial leverage because private equity buyout companies usually have a much larger and different debt structure from public equity companies to magnify their equity risk and return after paying for the higher debt servicing cost. While venture companies usually do not have any debt. Thirdly, we add a compensation for lack of access to invested capital. Fourthly, we add the value that general partners can generate through operating in the private market without the short-termism and formulating and executing a successful business strategy. And finally, we subtract fees paid to general partners in a typical private equity structure that include both base fee and performance fee. So if there's not any question, we can move on to the next slide for example of private real estate.
There are no further questions.
Here, we present the building blocks of expected returns for private real estate as an example for real assets. Again, we start from capitalization rate, which is a real estate jargon that is equivalent to gross yield on an investment, similar to the I block for public equity. Oh, sorry, this should be after the adjustment. So firstly, we subtract the capital expenditure needed to maintain the real estate asset to arrive at current net yield, which is similar to the I block for public equities. So what follow are the G and B block. For real estate, we believe that growth in net operating income is more sensitive to future inflation than to future GDP growth. And the valuation change is likely to result from the difference between the net capitalization rate and the nominal bond yield. The analysis so far is based on property data without considering leverage. Next, we adjust for the use of leverage, which magnifies both risk and expected return. Finally, we subtract the management fees because private real estate investment is deployed through managers. So now let's move on to the next slide. Now let us move on from expected returns to expected volatility and correlations. Volatility estimates seem a little simpler because the same technique and statistical methodology can be applied to the historical data of all asset segments. However, we do adjust when we think changes in economic factors have significantly altered the behavior of a certain asset segment. Correlation obviously requires estimation at the same time to ensure the full rank of the correlation matrix. We start with the MSCI Barra 1 model, but supersede our views based on macroeconomic analysis. Next slide, please. So all the inputs into CMA models, such as inflation, real GDP growth, and their derivative measures, such as nominal interest rate and the corporate earnings, are represented by their mean estimates. If the realized value are far away from their mean, manifesting as a macroeconomic shock, the realized returns, volatility, and correlations will also fall far away from the CMAs, disrupting our strategic plans relying on those CMAs. Sometimes macroeconomic shocks are caused by geopolitical shocks, such as the one we are in right now. And finally, we cannot list the things we don't know that we don't know, or things that we thought we know but can change just when we become comfortable. There's nothing we can do about uncertainty, but there are things we can do about unknowledge. So let's turn to the next slide for further developments. We're constantly on the lookout for new analysis, new insights, new models, and new methodology. As shown in previous slides, inflation and real GDP growth are fundamental inputs into CMAs of all asset segments. It is very important to keep the internal consistency of our models by using the same inputs across all asset segments. Under such conditions, any estimation error in inputs will affect all asset segments in the same way, so their relative rankings are maintained. Further research in macroeconomic area will improve upon our estimates of those fundamental inputs, thus improve the accuracy of all CMAs. Another area for improvements is in individual asset segments. For example, we gain deeper knowledge on the potential of operating improvement in private equity companies, or on the cause of valuation change in real estate, etc. With that, we are now open to questions.
Okay, I don't see any questions. Just a comment, if you go back to um, slide, the shocks to the estimates slide, couple back. Yes, this one. I would just suggest that the geopolitical shock from the pandemic is there now because it has occurred. But I think it really belongs under unknown risk because it was a black swan where you couldn't hardly predict that, uh, that event. So, I mean, it's there now because we know about it, but unknown risks to me are things like the pandemic. So, just an observation. Okay.
Yes.
Okay.
This presentation was finished in the pandemic.
Okay. Okay. Right. Okay. I understand. Okay. I see no further questions from any board member. So is that the conclusion of the presentation?
Yes.
Okay, well, I would like to thank you for this presentation and actually thank everyone, all of the panelists and the staff that, yeah, how about it for the staff and the panelists who participated today and also our public members. And I don't see any requests for anyone from the public to speak, so I assume there's no one. But I think it's also important that we thank the operational team because just think about this whole day, what was required to get us to this stage, the technology, the communications, the written materials. So it's a lot of people I know that are behind the scenes that make this happen. So I just we should applaud those individuals too. So thank you very much.
Agreed.
Okay, so the board will meet again tomorrow morning starting at 9 a.m. And feel free to join us then from the public and have a good afternoon, evening, everyone.